If you don't hold it, do you actually own it? In today's gold market, there is a growing divergence between paper claims and physical metal, and understanding that distinction is critical. What is paper gold? Paper gold includes ETFs, futures contracts, unallocated pooled accounts, bank-structured derivatives. These instruments provide price exposure, but they are financial claims. They rely on the counterparties. They exist within the financial system. And in periods of stress, that disparity becomes very important. The global gold market trades enormous paper volume relative to the actual available physical metal. In normal conditions, this functions smoothly. However, when delivery demand explodes, vault inventories decline, and geopolitical tensions escalate, paper pricing and actual physical availability can actually diverge. We have seen episodes where premiums expand sharply in physical markets, while futures markets trade at much lower levels. That is not theoretical, it reflects real supply-demand imbalances. Example, we are continually observed a clear pricing divergence between the Shanghai physical market and the Western future market. Shanghai Gold Exchange spot prices are materially higher than Western COMEX spot prices. This differential wasn't a few dollars, or is not a few dollars. It widened significantly enough that actual physical in Shanghai was trading at a significant premium over the paper price established in the West. Now, why does that matter? Because futures markets are predominantly paper. They are contract promises, not the metal itself. And in Shanghai, buyers were competing for physical delivery or near-term settlement, pushing spot prices much higher. This is classical supply-demand stress in the physical market, while the paper market didn't reflect that immediate scarcity. That divergence between what the metal actually costs to take delivery of versus what contracts trade for on an exchange is a live example of why the distinction between paper and physical actually matters. It is not theoretical, it's happening right now. Physical gold held in fully allocated form, fully segregated, outside the bank balance sheets, is not a liability of another institution. It carries no counterparty risk. You are not relying on the performance of a clearinghouse, a broker, or an ETF custodian. It is direct ownership. And during systematic stress, direct ownership matters. Paper instruments inherently carry risk. They provide liquidity, ease of trading, and tactical flexibility, but they serve a different purpose. Paper is for trading, physical is for wealth preservation. Conflating the two leads to misunderstanding. If your objective is short-term exposure, then paper may suffice. If your objective is long-term capital protection, wealth protection, physical ownership becomes strategically important. Because in times of stress, the question changes from what is the price to where is the metal and who owns it? And that distinction defines the difference between participation and ownership. If you want to continue to learn more about market cycles and precious metals, like and subscribe to our YouTube. And why not join our WhatsApp channel for regular exclusive updates as well.